What bombs will drop in the financial markets of 2023? It's a question you should be asking yourself. It's a question we should all be looking at because there's a lot of potential bombs. What will the Fed do? What's the bigger macro picture? What's going on with the Japanese bond, the ECB bonds, and what's going to happen with the S&P 500, the NASDAQ, risk assets, Bitcoin? What about Grayscale Bitcoin Trust, Tether, all of that? And we are going to go through all of that with pro analyst Dylan LeClair. Second time back on the channel, and he does not disappoint. He's a wealth of knowledge, and we're going to go through each one of these and look at what the potential risks are and try to map out what we think is going to happen in 2023. It's a conversation you do not want to miss, and so we're going to go through that. Now, I do want to also throw out one more thing before we jump into the interview. Regardless of what happens in the financial markets, the world's changing, and you need a new strategy to deal with that. And the way that we create wealth through businesses is changing, and the way that we invest our wealth is also changing. And so I am holding a 3-day event where we're going to talk about the new parallel economy. Right? There's an entire new economy that's being built outside of legacy systems. All right, and this is a way that you can build wealth faster, protect your wealth, and really we can change the direction of the world by building parallel economies. I have Robert Kiyosaki coming in to talk, several other experts. You don't want to miss it. There's a link down below. You can check it out or go to go.onemarkmoss.com/parallel to check it out, or check out the link down below. But let's just go ahead and just jump right into the interview with Dylan. All right, Dylan, here we go. Long overdue. I've had you once on the show. I'm excited to have you back again. So much stuff to discuss. So first of all, thanks for taking the time.
Yeah, thanks for having me on, Mark. It's good to connect again. Saw each other in Los Angeles a couple months back, and certainly a lot has transpired since then. So we got some stuff to catch up on.
It makes our jobs easier when there's actually stuff to talk about, right? I started making content for Bitcoin in 2016. Then I made crypto content. I'm not really ashamed to admit I did for a while. 2019, I kind of just got off that and just went back to Bitcoin only. But I remember like 2018, 2019, like there was just nothing to talk about. Like there was nothing going on like in the depths of the bear market. This bear market has been fireworks. There's plenty to talk about. I want to talk about, let's start like macro, and then let's kind of like dive down into that. So let's start with the big macro picture, which it seems like regardless of what any on-chain data or technical analysis or even fundamental analysis tells us, it seems like the macro picture's in charge. And when I say the macro, like the dollar, the Fed. So let's start there. Let's talk about the Fed. You know, obviously they said they were going to raise rates. Well, first they said they weren't even thinking about. Then they said they weren't going to raise rates for 4 years. Then they said, okay, we're going to start raising rates in November. And risk assets have just continued to sell off. They've raised rates at the fastest and most aggressive rate in history. It seems like they're about to break something, which Powell said he's happy to break something because they can rebuild it, which kind of shows what they're doing. I tend to kind of take them at their word. They're not really trying to surprise the markets. They're trying to really kind of project what they're doing. What's your view on this whole macro picture of what's going on and kind of where we're at in the cycle? Have they given us ultimate pain, or we still got more pain to go?
Yeah, I mean that's a $1 trillion question. I kind of ultimately believe that there is more pain to go in this macro cycle into 2023. I mean, I don't know the specifics, obviously. Equity bear markets, and financial assets in general are characterized by, face-ripping reversal rallies. But I really think that higher for longer is the reality, and everybody trying to front run, this pivot, especially equity investors, right? The more that financial conditions loosen across the board, the more room, paradoxically, the more that people buy the dip and the more that people chase stocks here, that the more room it actually gives the Fed to tighten the belt more. And so we kind of see this play out in kind of this like jigsaw pattern throughout 2022 where, things get too bearish and then it reverses, volatility comes back in, and Powell goes, nope, guys, like just pack it up, go home. So I don't necessarily think that 3,000 on the S&P is going to happen tomorrow. But I do think that most of the kind of the repricing in global assets and in global financial markets was due to the discount rate rising rapidly, obviously. And that was because of Fed tightening, but also bond investors realizing, okay, if we're out of this disinflationary regime and potentially entering a new one, what's this new cost of capital? How should I be, pricing the discount rate 10 years out, 30 years out? And so I think, the S&P at 4,000, there's, the equity risk premium, if you look at, say, and that's a big word, but if you look at just say, because investing's relative, right? So if you look at bonds compared to equities, it's actually kind of paradoxically, equities are more expensive here than they were at the beginning of 2022 relative to bond markets. So I think that's something that investors should keep in mind, just so they're not surprised if we do see some more downside, because I still think that until said otherwise, right, the Fed pivot is kind of this more so a buzzword than anything, and a pivot is actually going to require some real pain to be felt in employment, housing, and more so in financial markets.
So that last piece that you said there, so it's going to require more pain in the economy, the housing markets, et cetera. So, but you started out by saying that the stocks going up give the Fed more room to tighten. And so it seems to me that the Fed doesn't really care about your stocks. They don't care about your house. They don't care about your retirement. They actually want to bring those down because they're trying to crush demand. What they do probably care about is obviously liquidity in the banking system. They care about maybe the economy, unemployment. That's one of their dual mandates, right? So do you think stocks being high actually gives them room to tighten, or do they not care about that and really they're looking at, like, again, the employment and like bank liquidity? Or do you see it more holistically?
Yeah, I think that just, a lot of investors kind of haven't realized, but there was somewhat of a regime change in 2020 or maybe 2021, 2022, right? Where for the past few decades, investors were rewarded with buying the dip, and the Fed and global central banks could really inject an unlimited amount of liquidity, and it wouldn't show up in consumer price inflation. Obviously, we saw CPI at 40-year highs, and the Fed came out and said, all right, well, we really got to get this lower. Inflation, low inflation is one of our core mandates. And we see that not just in the Fed, but the Eurozone, the Bank of Japan, et cetera, right? So what that means, and they literally are telling you this, they say, we want unemployment higher, right? So even though it's part of their dual mandate, they're honestly really like embarking on a mission to reverse engineer the wealth effect, lower assets, and also higher unemployment to crush that demand, like you said. And so I don't think that job is finished. I think inflation is stickier than a lot of people expect, despite kind of the reversal in the year-over-year prints we've seen over the last 5 or 6 months. It's still a lot higher than their 2% mandate, which is arbitrary, yes. But some of these things, like core CPI, is a lot stickier than I think a lot of investors expect. So for that reason, I think that we're still in a tightening cycle until said otherwise. And if you look at the history of Fed pivots, they don't pivot until things get bad, and actually things often get worse after the pivot.
Get worse,
yeah. So we'll see here, but I think for the bulls that are chasing here, they might be a little bit blindsided by macro conditionings, liquidity, and real like economic data, not financial assets, getting worse into 2023. So we'll see how that stands.
Yeah, I mean, obviously none of us have a crystal ball, and I constantly reference the insanity that we all have to sit around and try to read some guy's mind to understand what's going to happen with our money. I mean, it's just the stupidest thing in the world, but it's the world that we have, right?
That's the game.
What's our fate? Let's all listen to Jerome Powell. I often liken it to the insanity. I'm in Southern California, but the insanity of the Punxsutawney Phil or whatever, right? The groundhog. Like, if he comes out and sees his own shadow, like spring goes longer or whatever, and like everyone watches the groundhog, and it's like that's kind of like we're all watching like Jerome Powell. But it is what it is, right? And so we kind of have to navigate that. But it seems like Jerome Powell tries to be very clear, like, hey, there's more pain ahead, pain, pain, pain. He finishes the meeting, he's like, hey, guys, you're not listening to me. Like, the stock market's rallying, but, like, I'm telling you there's more pain, right? And it almost seems like the markets are calling his bluff. Like, we get it, you're serious, and we get it, you're committed to sticking with it, and we get it, there's pain, and we get it, we understand it, and we believe you, and we believe that you believe it. But we also see the constraint that you're going to run up against. And so we're betting that we can hold on longer than you can hang on. Maybe the markets are saying something like that. Do you think maybe there's like this little chicken and egg, or not, game of chicken going on where the markets are like, okay, we get it, but we bet you the banking system liquidity is going to dry up before this happens? Or do you think it's just the people are stupid and they're just trying to buy the dip?
Yeah, I mean, I think a big driver, a big driver in equity markets is often just price agnostic passive flows, right? It's not actually like astute active investors making, really advanced financial decisions. It's just pensions, 401ks plowing money into broad-based equity and bond indices, right? And they don't even know what they're buying at what price. They don't care, right? They're investing for the long term, and often that's why you see like these severe dislocations, whether over the short term or the long term, right? And then active managers on the margin, whether it's long, short, etc., right, kind of have to clean up this mess. But sometimes the tail wags the dog. So I do think there's excess liquidity still in the banking system, right? There's still $2 trillion in the reverse repo just parked there, getting 4.5% yield, right? So until that draws down meaningfully, there is excess liquidity in the banking system at the very least. But yeah, I think that, Powell, he's literally said, right, like there was this one, I think it was a month or two back, when someone incorrectly during the FOMC meeting said, hey, bond and equity markets are rallying, and that was a lie, right? And Powell like almost like shook his head like, geez, and came out like super aggressively hawkish and was like, guys, listen up, like, and that was like wow, he's serious. So I think over the long term, right, everybody knows, Mark, you talk about it a lot, I talk about it a lot, these debt dynamics, right, 120% federal debt to GDP, global debt to GDP at 350%. These things are unsustainable, and the only way out is financial repression, monetary debasement, right? A sustained period of inflation higher than interest rates. So tightening can't be the game forever, but I think to get there, right, the pendulum almost has to swing to the far extreme of, oh wow, the easing is a must, and I don't think we're there yet. So is it a game of tea leaves and reading this magic ball? Yes, right. But unfortunately or fortunately, that's the game we're all playing.
Yeah, and again, I take him at his word. I believe the Fed tries to project out what they're doing. So he said in November 21 that they're going to start raising rates. He didn't start raising rates until March of 2022. So like they give you this long, wide time frame. Now, again, he said we wouldn't raise rates for 4 years. He did in 2 years. Now they're saying they're going to keep rates really high. But things change. But I think when he said that we'd rather break things because we can rebuild them, I think you have to take that part pretty seriously. And so to your point, there's a lot of liquidity in the system. He's prepared to see it break. I think, and again, this is just my my opinion for what it's worth, nothing. But I think that probably this year we see it get worse faster than he expects, and things do break, and then they knee-jerk reaction and blow it back sky high again. But we'll see. If we go, I guess even a little bit further, although the Fed is kind of driving that. I know big news. It seems like also, talking about like liquidity in the system, Japan being one of the largest holders of treasuries, has been selling treasuries. Right, Japan is basically just like FTX. Right, if you look at it like a small microcosm, like FTX created a token out of thin air, their FTT token. Nobody really wanted to buy the FTT token, but they manipulated the market, so it made it look like there was value, so people bought it. When nobody wanted to hold the token anymore, they started dumping the FTT token, and so then FTX was forced to try to prop it up, buy it. So they're selling whatever assets they could to prop up the token, but it didn't matter. Nobody wanted it, and it fell. And if you look at that, and then look at Japan, Japan's the same thing, right? Japan has a yen token. Nobody wants the yen token. They manipulate the market to think it has value. Now they're stuck selling treasuries to try to prop up the yen token. But like it's just only a matter of time, right? And I think the big thing that I want to ask you about was the yield curve control. So what seems to kind of catch me about this story is, so for people that don't really understand, is that Japan basically manipulates their bond market to kind of artificially peg the rates. And the thing that catches my eye is that they had to change the rate they're pegging it at. And it seems like I've always said that pegs are meant to be broken. Traders are always going to go after the peg. George Soros got famously rich in a day from breaking the peg and the Bank of England. And once they give in once, the traders are kind of like, oh, okay, now we know you're going to give in. Does that kind of open up the floodgates, do you think? Was that like you flinched first, now you're probably going to lose kind of sign?
Yeah, I think certainly adjusting that policy rate, kind of erodes the credibility. And people argue back and forth whether central banks have any credibility left. I think they, somewhat they do, right? And given that, right, the Bank of Japan has $1 trillion at their disposal. Yeah, so somewhat of an FTX type situation, but they have a quite a big war chest to keep this game going right now. So I kind of I like to explain yield curve control, quantitative easing, like these kind of big terms that seem very complex. Like quantitative easing, right, is printing a fixed amount of money and buying bonds at any price, right? Yield curve control is printing potentially an unlimited amount of money to keep the bonds at a fixed price, right? So it goes lower than this price, it goes higher than this yield, right? Because bond prices and yields are inverse of each other. So if it goes above 25 basis points, which they switch to 50 basis points, 0.55%, we'll print any amount of money to keep this 10-year yield at this rate. And they have to do this. Why? Because their debt to GDP is the worst in the world. I believe it's like 270%, right? So mathematically, they need to erode their real debt burdens, and how are they going to do that? Well, they need to let inflation rip, and they need to keep their bond yields pinned, because otherwise, the sovereign, the Japanese government goes belly up, essentially, right? So speculators all over the market are saying, all right, well, if you're going to print this money, we're just going to short the yen. We're just going to short the yen and get dollars. And so the Bank of Japan comes in and really to kind of stem the speculators, they sell a bunch of dollars and buy the yen, right? So it's almost a circular logic in a way, right? Because they're printing yen to buy their bonds, and then they're selling dollars to buy the yen, right? So they can keep this game going for a while because they are one of the world's biggest holders of treasuries. But eventually, right, the speculators who are both shorting the bonds and the yen are gonna, maybe not break the Bank of Japan because they're, quite the titan in the market. But they're gonna burn through that treasure chest eventually. So it's gonna be really interesting to follow that.
So why do you think following that is even important? I mean, if it's so far off.
Well, I think one of the biggest things, right, is you can see, and Bloomberg has released a couple of stories on this, right? So there's the bond yields, right? But there's also the kind of the swaps. So traders, there's derivatives, and there's these swap rates. They're almost like kind of bond futures. And so those swap rates, while the peg was at 25 basis points, 0.25%, those swap traders had that policy rate at like 40 or 50 basis points. So they were already front running the move. And now those swap rates for the 10-year yield for the Japanese government bonds are at about 80, 90 basis points. So 0.8, 0.9%, right? So they're already front running that next kind of capitulation move by shorting these bonds. And I think what the key here is that sovereign debt, whether it's the Eurozone or the U.S. Treasuries or Japanese government bonds, right? These are the biggest markets. Sovereign debt is fungible on a FX hedged basis. What do I mean by that? It means that global debt, especially from sovereigns that won't nominally default on their debt, right? A corporation may or may not default on their debt. Well, for a sovereign, they're just going to print the money, essentially. So they're never going to nominally default on their debt. So there's derivatives that you can basically hedge out the currency risk. So investors of Japanese government bonds would say, hey, maybe I'll just hedge my yen exposure and buy treasuries instead. So when the Bank of Japan is printing a ton of money to keep their bond yields artificially suppressed, that actually affects the bond yields of every other market in the world. And so you saw when they capitulated and when they went from 25 basis points to 50 basis points, global bond yields immediately ratcheted upwards, right? So bonds sold off. And so I think that's the kind of the move here is that, who knows what their policy will go to next, right? They certainly have a huge treasure chest and are willing to burn through it. But the yen and really the Japanese government bond market is basically one of the biggest currencies, one of the biggest bond markets in the world aside from the dollar and the treasury market. And so, they own a whole bunch of it. They own like 50% of the government bonds. But depending on where those yields go, global markets could react quite meaningfully.
Okay, so it's interesting for traders. It maybe isn't as important for the global macro picture because they have quite a long runway of $1 trillion worth of bonds in front of them. So nothing really imminent there. It's more just kind of interesting than it is potentially imminent moves for the rest of the global market.
I think that's fair to say. I mean, certainly something to keep an eye on. Maybe for the average investor, that's just maybe passively holding a portfolio or investing for the long term. It's following the yen or the Japanese government bond policy rate probably isn't top of mind. But for macro traders in the weeds, this is certainly one of the bigger variables in the market.
Yeah. I think when it eventually breaks, then it will have massive impacts through the global economy. But maybe that doesn't happen for a while. So now that we've kind of talked about the big macro, is there anything else big on the big macro before we maybe kind of start diving down in? Anything on the ECB or Euro that is like maybe big and happening that you see?
Yeah, I mean, I would just say I expect, despite the recent weakness, and I don't really have like a set timeline for this thesis or for this move, but I think the recent dollar weakness is something that I don't expect to continue forever, right? That everybody says, and I agree, over the long term, the dollar is guaranteed to debase in value, right? But what you're comparing it to when you're looking at, like, say, the DXY, the Dixie, or when you're looking at FX markets, you're comparing it to a basket of other fiat currencies, right? So the euro, the yen, the pound, the yuan, right? Well, the biggest component of the Dixie is the euro, right? Their economies, their demographics, and their monetary policy is actually in a far worse position than the U.S. and the Fed, right? So people say the Fed is trapped. Well, the Bank of Japan is a lot more trapped than the Fed ever was, and the ECB is a lot more trapped than the Fed also was or is, right? So I just suspect at some point, whether it's next week, next month, next quarter, next year, I think the dollar bull market against other currencies will continue. Against other fiat currencies will continue because there's just this massive global dollar short position, right? There's all this dollar-denominated debt around the world. The U.S. is and has been for the last 50-plus years the world reserve currency. And so because of that, there's this natural global short position, right? People that are familiar with short squeezes in stocks, right? Whether it's like meme stocks like GameStop or there's short squeezes in Tesla or whatever it may be, right? But the biggest short position in the world is dollars. So I think that's kind of an important dynamic to understand as we are in a tightening cycle, as the Fed is tightening the belt, as rates and interest expense around the world for variable rate debt goes up. This game of musical chairs, that is this global debt-based monetary system, the music is slowly stopping, right? And I'm not saying the music is going to outright halt, but as these chairs fill up, it's going to be interesting to see how it all plays out for the dollar and for risk assets.
Yeah, and risk assets have been catching a bid. Even specifically, gold's been catching a bid. I mean, if you look at the DXY, where it really started breaking down, and I mean that's right when gold and silver and precious metals really caught a bid and have done really well in that same time frame. And if you then go, well, Dixie is only measured against these other basket of currencies, which are even more weak, then potentially the dollar rallies again. And what does that do for risk on assets? So typically, gold has moved off of real rates, but it seems to really be correlated with the Dixie for now. So I guess we'll have to kind of keep an eye on that. But if we jump down even further back into risk assets, I mean, risk assets have been catching a bid. Specifically, Bitcoin and cryptocurrencies have been catching a bid. Bitcoin is trying to get to that $19,000 level, which is pretty amazing. We've been kind of stuck in this like $16,000 range for months now. Bitcoin was kind of almost trading like a stable coin there for a minute. I've talked about extensively, and I know you dig into the on-chain data a lot. And really simply, I've always believed that I think a lot of economics can be really boiled down simply, right? Like markets stop going down when there's no more sellers. Markets stop going up when there's no more buyers, right? Price is typically set by supply and demand, right? Things like that. And so if you look at from the Terra Luna domino through the Three Arrows and Celsius all the way to and then we had Celsius. And then we had the miner capitulation, where the miners basically dumped all their Bitcoin. And then Bitcoin kind of hit that $15,000, $16,000 price point. And it seemed like we hit capitulation there. Then you see like FTX happened, and it didn't really push Bitcoin down anymore. Of course, we found out FTX had 1.4 billion of Bitcoin on their books and didn't have any to sell. So maybe that had something to do with it. There was no more sellers. And it seems like Bitcoin kind of found that bottom massive buying volume when it tried to touch that, just below the $16,000, $15,000 price point. So it seems like it's found a bottom. It's now starting to catch a little bit of a bid here. I'm just curious what you think about that potential bottom. Do you think it's found a good bottom? Is it an intermediate bottom? Or do you think really back to this global macro picture still really in charge, and we have to kind of see what happens there?
Yeah. I think, in terms of the amount of forced selling that happened in 2022, it's going to be extremely hard. I mean, maybe even impossible to replicate that again in 2023, right? They're at a certain point, especially for an absolutely scarce, fixed supply asset, the marginal seller does get exhausted, right? So if you haven't sold your Bitcoin in the latter months of 2021 or 2022, all of 2022, right? not sure what's going to get you to dump all of your bags here, right? And certainly, like, if equities reverse, if the dollar strengthens, if global bonds sell off again, it's all off the table. But in terms of like Bitcoin specific, crypto specific, forced deleveraging, I think we've seen the brunt of that. But I think there's a key distinction between, if the low is in, or at least, the low in terms of a range, right? Whether it's, the tick of 15.5 or whatever it may be, or just like the 16K to 18K to 20K range, whatever it is. I think there's a real difference between, okay, maybe the low's in, which I believe is a strong possibility, versus the start of a new secular bull market, right? So, I think we'll see, but I think 2023, at least for Bitcoin, at least for the start of it, and maybe we see a nice, bear market rally, but I think it's going to be kind of characterized by a lot of chop, right? There are buyers of Bitcoin here, and anecdotally and via the data, I can see that there are price agnostic buyers of Bitcoin at any price that just continue to buy, hold, and accumulate and not sell it, right? So there are those flows. But in terms of, kind of this up only, generational bull market resuming, at least today, I think that's a little bit of a ways off. So I think we got some time. I think Bitcoin will consolidate for a while. Could certainly be wrong there, but I kind of expect just, minimal volatility relative to maybe the 2021 up only bull market and relative to the forced deleveraging of 2022. I think, somewhat of a calmer period, fortunately or not, for Bitcoin is ahead in 2023.
Sure. I mean, that's what always happens, right? That's the cycle of the market, right? So at the bottom, you have the euphoria at the top, right? The volatility at the top, and then the massive sell-off. And so those two are both traits of that. All the people that came in at the top of the mania that drove it higher are the ones that get out at the top and then force it back down and faster. And then at the bottom, the pit of despair, nobody wants to touch it. And so you have to kind of sit there and wallow in this very slow increase again until eventually it starts to catch on to people's imagination, and long before even that euphoria gets there. But that's kind of the market cycle. We'll see. But yeah, it just seems like it could be there. And to your point, I would agree. I wouldn't expect a big firework year in 2023. But then you have this looming macro thing kind of hanging. So that seems to be the big thing, which I want to come back to before we wrap it up, and I'll ask you about that. Bloomberg had put out a piece of research at the end of last year, and they said that they believe that Bitcoin would turn into a risk-off asset by Q3 of 2022. If you look at the world from a bigger perspective, geopolitical perspective, and how the world's kind of breaking up, and supply chains are being reshaped, and I believe, I talk about all the time, we're going into a decentralized world. We're going into a multipolar world. I think trade and supply chains is going to suffer, right? It's going to all have to be reimagined. A lot less trust. There's new payment networks being set up. I think that could be good for Bitcoin, right? We see a lot of nations are buying massive amounts of gold. Gold doesn't really work very well in a technological age. Do you think, like Bloomberg, that maybe we could see Bitcoin kind of transform from this risk-on asset to maybe more of a risk-off asset, and could that be this year?
Yeah, I think that's I think it's a good narrative, and I would be delighted to see it actually unfold. In the interim, I think that like Bitcoin, think of it as a fraction, which it is. All financial assets are. It's the numerator, the denominator. The numerator is BTC. It certainly has its own wave of adoption, speculation, buying, selling, forced deleveraging, and then there's the USD component, right? And as Bitcoin kind of monetizes across global balance sheets, it's kind of nestling itself on the asset side of the global balance sheet. So there's assets, equities, bonds. Bonds are both on the asset and liability side. Bitcoin's only an asset. It's not a liability of anybody, similar to gold. And then on the liability side, there's, dollars, euros, yen, all the currencies. And so I think that it's, people necessarily are saying, when's the decoupling? Is Bitcoin ever going to not be a risk-on asset? And personally, I don't think the correlation with global risk is actually a bad thing. I think it's almost a good thing. So we'll see. I think there's going to be, momentary periods of decoupling, or, for instance, Bitcoin could have an up day due to a short squeeze, or, a big buyer coming in while stocks are down and the dollar's up. But a sustained period of inverse correlation to global risk is not something that I really expect here. But again, would be delighted to see it happen, because that would certainly be a really strong narrative shift.
Now, you one thing that you've been all over, and you're getting quite the following for, is breaking down some of these big moves, FTX, et cetera. And one you've been following a lot is this whole Grayscale GBTC thing. Now, we talked about, has the market bottomed? Has it exhausted sellers? You think that maybe it has exhausted sellers, sort of like I was kind of saying. But what is the risk of a massive sell-off in the GBTC thing? Why don't you kind of frame that deal up for us?
Yeah, so, essentially Grayscale GBTC is a closed-end Bitcoin trust. Actually, Mark, do you want me to kind of break down what GBTC is, or are your viewers familiar?
Let's do that. Give it quite a little overview.
Okay, cool. Yeah, so GBTC is a trust offered by Grayscale. Grayscale is a subsidiary of Digital Currency Group, a big conglomerate in the crypto industry. It was kind of the first Bitcoin trust that was offered via OTC over-the-counter rails, right? So, you could buy it in your Roth IRA, or in especially in 2020, 2021, was kind of a favorite of Wall Street to get Bitcoin-like exposure. This was before, the MicroStrategies of the world, a lot of the Bitcoin miners go public, before futures ETF, right? So there wasn't really an easy vehicle for Bitcoin-like exposure to be accessed. So GBTC was that product, right? And because it was a closed-end trust, there was only creation of shares, no redemptions, right? So you could bring dollars or Bitcoin to Grayscale, and they would give you a shares of GBTC. And because it was only one way, it traded at a premium for a long period of time. So it was, say you'd bring $1 to Grayscale and they'd give you GBTC shares that were locked for 6 months. That's a big story. And those shares at a 20% premium would say trade at $1.20. So there was a lot of investors that even didn't really have much interest in getting Bitcoin exposure that entered the GBTC trade just to kind of harvest that premium. And that was a huge driver in the bull market, right? So everybody thinks of Saylor, which he was a big driver of the bull market, but everyone thinks Saylor was the biggest catalyst in 2020. Saylor bought 100,000 Bitcoin. He has 130,000 Bitcoin. MicroStrategy currently does. Grayscale, from 2020 to when they stopped buying Bitcoin after the premium went to a discount, Grayscale bought 400,000 Bitcoin, right? So they were a massive driver of this bull run momentum. And what happened was that premium, as it turns out, a bunch of firms were levering up to take on this trade, and a subsidiary of DCG, Genesis Global, a trading firm, was lending against these collateralized GBTC shares to lever up and kind of repeat the trade, right? So there was a bunch of people going in, giving Bitcoin to Grayscale, getting GBTC shares. They'd give those shares to Genesis, borrow more money, and do the trade again. Three Arrows, one of the industry's biggest hedge funds, did this trade and made a whole lot of money. As it turns out, GBTC is not a very liquid market, at least relative to Bitcoin. And all that leverage, as that premium in February of 2021 whittled to zero and actually turned into a discount to net asset value, one of the biggest catalysts for the bull market actually turned to be a big drag. And so right now, that premium or / discount to net asset value for GBTC shares is about 36% discount. That reached as low as 50%. And as it turns out, yeah, so it has been getting a bid recently, and there are some activist campaigns to organize shareholders. And so we'll see what happens there. But there's around 600,000, 630,000 Bitcoin wrapped in this trust, and there's no kind of way out. It's almost like a Hotel California of sorts in a financial asset wrapper. And so we'll see what happens, but I think this is one of the bigger stories, and Genesis and specifically DCG as this big industry conglomerate is kind of in the middle of some big issues with liquidity, potentially solvency. And you have big claims from, say the Winklevoss twins running Gemini Exchange, calling for fraud of the CEO, Barry Silbert, of DCG. So we'll see what happens. They owe Genesis a whole lot of money, about $900 million for their yield product, Gemini's yield product. There's a whole bunch of kind of crypto contagion that actually still hasn't played out. That was a story of 2022, and it's not yet finished. So I think most of that forced selling, that deleveraging and solvencies has taken place. But as it turns out, that daisy chain of leverage has potentially a few more victims to kind of wash ashore. So we'll see how it resolves. But I think that's certainly one of the things to watch into 2023.
Yeah, that's the thing with leverage. It works really good on the way up, and it works equally good on the way back down to destroy you. I often call it like fire, right? Where like I can use fire to warm my house, or it can burn my house down. You know, like you got to be really careful with that leverage. But in regards to that, I mean, back to the original question. You don't see in your research, and you've done a lot of it. You've done really well with it. Follow Dylan for that if you want it. But you don't see. I mean, so the company DCG at the top and Genesis, you know, subsidiaries, et cetera. You don't see any risk of like a forced liquidation. I mean, if anything, it would be returning the Bitcoin back to the owners that are owners of the trust. There's no reason why there would be like a forced liquidation or a mass dumping onto the market because of that, other than maybe going back to the owners, the holders, and then they want to sell it.
Yeah, I think there's a lot of scenarios that can play out. I'm not sure how to quantify these things. And there's, I think that actually the smallest probability is that the status quo remains for the next, 2, 3, 4 years. That's what DCG.
That's the smallest possibility.
Maybe that's a bold take. But I just, off of the allegations, off of the recent momentum in shareholder activism, the stories that have come across the PR newswire about the SEC and some other potentially DOJ looking into DCG's operations. There's the real potential for this thing for the trust to be unwound or to be acquired by a new owner or manager of the trust. And potentially, one of the biggest things that's dragging out this discount, right, is the fee structure. It's a 2% annual fee forever, right? So similar to how you discount a stock's earnings or a bond for 10 years, 15 years, 20 years, the market is discounting this 2% fee in perpetuity, right? So why would I hold GBTC shares at a 2% fee forever when I could just hold Bitcoin? So that's a big reason for the discount. Another big reason for the discount is like Genesis and DCG being levered against GBTC shares. So that forced selling that had to be absorbed didn't really have any natural buyers. But in terms of like what's resolved, I think there's a small chance. And I don't know how to exactly quantify this. I would love to if I could. But I think there's a small chance that the trust is liquidated. I don't think it would be a $600,000, a 600,000 Bitcoin market sell on Coinbase. I think there'd be a lot of interested OTC buyers, potentially, the buyers that had GBTC shares just stepping in with the cash they received. It's really unclear how it all works legally, but I do know there's mounting pressure from regulatory bodies, from shareholders, and just, judging off some of the names that I've heard through the grapevine that are kind of interested in this activist play. There's some serious momentum here. So, DCG potentially is on the ropes here. And I think that there's, potentially some change coming over the coming, I don't know about 2023. Like I don't have a specific timeline for it, but, it's more momentum than there ever has been to get a change to this structure.
But the change, I guess the point that I'm just trying to clarify for myself and for everyone else is that the change, whether that be, breaking it apart from DCG's grip, getting Silbert out of the way, putting somebody else there, or even potentially unwinding it and giving the Bitcoin back to the owners, there's not a big liquidity event. Most likely is not the base case that there's a big liquidity event off of this. I mean, there's change for sure, but it doesn't mean there's a mass liquidation.
Yeah, I agree there. I think there's a tail risk for everything, but also interestingly, Mark, there's even the chance that, and again, unsure how to quantify this, but I do know just off of my own intuition and just some chatter, with some market participants that a popular trade that has arisen recently, given, say, GBTC is at a 50% discount to net asset value, right? So a popular trade, even at not 50%, maybe 40%, 36% to net asset value, is long GBTC, short Bitcoin futures, right? So if that has to be unwound, what's the result? And I think the result is you have to unwind that short leg. So unsure of how it plays. I think it could interestingly go both ways, or it could just kind of resolve without a bang and just kind of a little murmur. So we'll see what happens.
Yeah. On a little bit of a different note, but referencing the 2% premium on the GBTC, which is a very healthy premium. I mean, it's kind of industry standard, but it is a very healthy premium. And why would they want to unwind it when they're making so much money? But I recently just did a video on counterfeit capitalism and Ponzi finance. And I was looking at Blackstone. So Blackstone has become like the largest owner of real estate like in the world. And they have this like $68 billion BREIT, they call it, like a REIT, but they call it a BREIT. They charge 3.6% a year. They're pulling in $2 billion a year just off of that alone. So anyway, put the 2% in perspective. Yeah, Blackstone is charging you 3.6, and with Blackstone, they don't. It's a real estate portfolio. They don't mark to market it, right? And they don't even bring in auditors. So they have their own internal accounting team set the value of the portfolio that they then charge 3.6% on. So the investors of the BREIT have no control over what they're buying. So they're buying a bunch of probably toxic assets at this point, shopping centers and business parks in San Francisco, for example. Who knows? You don't even know what you're getting. And then you're getting, it's not even being marked to market. They're setting it. They're controlling it. They're skimming 3.6% off the top of it. I mean, it's just a disaster. So sign of the times, right? That was the point of the video. Sign of the times. It's Ponzi finance time. That's kind of where we're at.
Mark, I think one of the most interesting things, just to add one little quick tidbit to that point, is that one of the biggest beneficiaries of this 10, 12 year up only bull market and everything has been private equity, right?
Yeah.
And private equity is this magical vehicle that has all of the upside exposure to financial asset market beta with none of the downside volatility, because these things aren't marked to market on a daily basis. And as you see with Blackstone and some other private equity funds, as the withdrawals start to come in, are those marks real? And is there buy-side liquidity to meet those withdrawals? I think that's maybe a potentially a big story in 2023.
It's going to be a real big story. Private equity is the big Ponzi that I believe is going to collapse, assuming the market kind of continues on the trajectory that it's on, like we talked about before. If there's more pain ahead, I think private equity is going to take a massive hit. I was reading this article by Matt Stoller. He writes a Substack called Big, and he talks about monopolies. And he was talking about the private equity and how they've taken over like the medical industry, the hospital industry. And they're raising all this money. They're buying the hospitals, and then they own the land separately. And private equity, they do all these roll-ups, and they're not specialists in running these businesses. They bring in generalists to run a specialized business, and in most cases, they do a horrible job at it. So they've rolled up these hospitals. They're having a horrible job. The hospitals aren't being run properly. They're going out of business. They can't afford the lease on the land that the PE also owns. And the PE the private equity, is loaning money to the hospital so the hospital can continue to pay the land lease, which they also own. So they're loaning money to get their payments back, but because they're separate entities, then private equity can go, look, we've never missed a payment. Oh, look, the revenues are still coming in, even though they're losing over on this side. So it's Ponzi finance is back to that kind of thing. But yeah, private equity is a disaster waiting to happen. It'll reset like everything else, I guess. Okay, what about Tether FUD? Let's talk about that for a second. Now, I got into this space in 2015. As long as I can remember, there's been Tether FUD. Tether prints dollars to prop up Bitcoin. Bitcoin's price wouldn't be where it was if it wasn't for all these fake dollars. Which, if that was the case, then why has it been sitting at 16,000? Like, can't they pump it back up already? There's a lot of FUD, right? Fear, uncertainty, and doubt cast onto Tether. A couple things I want to ask you. One, what do you think the reality is of some of this danger? And then two, the bigger one, kind of back to this: is there more mass liquidations in front of us? Does it even matter? Right? People are holding a bunch of dollars. If they lose their dollars, does that matter to Bitcoin? So what do you think about those two things?
Yeah, I think the long-term answer is no, it doesn't matter. Like Bitcoin is just this machine that is unaware of any of us and how we interact with it, and it'll continue to just chug a new block every 10 minutes, and it's just this immutable network of value, settlement, and storage. In terms of the dollar exchange rate, Tether is obviously a massive player. I believe something like $50-60 billion of market capitalization. Has a shoddy past for sure. Potentially, some kind of commingling with Bitfinex. They've, been sued by the New York AG. All of these things have, past question marks. And certainly, like, maybe they like that's the reason, right? They can't get an audit is because there's somewhat of a shady past. So do I hold Tether? No, I don't. Do I think Tether is going to imminently collapse? No, I don't. I believe they have a big portion, a big chunk of treasuries, and just based on everything that's happened in 2022, if that wasn't enough to kind of topple Tether, don't really see what's going to come that will. With that being said, Tether has had a history of saying, hey, like we hold just assets backing our dollars, right? And then Celsius, when they go under, it's revealed that Tether actually was lending Celsius collateralized loans, was creating tethers through Bitcoin collateralized loans. So Alex Mashinsky sent over some Bitcoin, over collateralized, of course. So Tether didn't actually sustain losses, but they printed Tether backed by Bitcoin collateralized loans. So that was something that Tether said they didn't do. So are there questions? Certainly. Would that actually help support the price of Bitcoin? Certainly. But at this point, Tether has done, they used to hold all this commercial paper, all of this. They are sitting on a portfolio of mostly short-term treasuries at this point. And so I think they're okay. I think that the yield that they're now getting on this massive portfolio is certainly going to help bolster their reserves over the long term. And I don't really have a kind of an immediate doomsday prediction on Tether like I've called out a whole bunch of these yield products, right? Like you take off the box, Celsius, Voyager, BlockFi, FTX, right? Like I've, among others, right? Called for all of these things to collapse before they did. Do I think there's question marks about Tether? Of course. Do I think that they, are the next domino that's going to collapse this entire industry and Bitcoin is a scam like all these bears are saying for the last 7 years? No, I don't believe so. Certainly it's a big market player. It's, the dominant trading pair on Binance, right? But I think it's more so propping up, if it is propping up anything, it's more so propping up the broad-based crypto industry rather than, Bitcoin as a global, free float financial asset.
Yeah. I mean, that's kind of my take. And I guess just kind of back to the question is that it's propping up the entire ecosystem to the kind of point that you made on Binance, et cetera, crypto coins, et cetera. But, and to your point, and that's one thing that people should take from this is when you see that these like stable coins are 100% reserved. Well, reserved in what? Like if you're reserved in FTT token, your reserve ends up at zero. Or like if you're like Terra Luna was reserved in Terra token, right? Like, well, then it went to zero. So reserved in what? And to your point about Tether, a good majority of that is now in treasury. So it's like basically in cash. But I guess the question is, if they were, hypothetically, a bunch of stuff comes out, they don't have the reserves, there's a run on Tether, orchestrated by whatever reason, and Tether were to go to zero, would that really have a big effect on Bitcoin specifically? I mean, they're not dumping Bitcoin. I mean, the people that had dollars there, had those Tether tokens, now can't redeem it for the dollars they hoped for. But it doesn't really cause a mass liquidation of Bitcoin necessarily.
Nope, it doesn't. It would be really interesting to see happen, Mark, because, again, like I don't think this is a high probability, but we've seen temporary kind of like, so Tether trades free float, right? It trades against other stablecoins. It trades against like Bitcoin, BTC, USD. Also, there's BTC, USDT, right? And so we've seen in the momentary kind of periods of market panic, whether it was the collapse of Terra Luna, the collapse of FTX, we've seen Tether trade from $1 to 99 cents, 98 cents, 97 cents, right? And it was quickly bought back up. But a lot of those traders, a lot of those people that bought Tethers at 97, 98 cents went to Tether and redeemed them, right? So they got the cash, whether through a bank wire or whatever the means may be. So and at that time, right, it was interesting to see on say a Binance that the price of Bitcoin in USD was like 28,000, and the price of Bitcoin in USDT was like 29,000, right? So it would be really interesting to see Bitcoin pump if the denominator of BTC USDT was collapsing, right? And it would be interesting to see kind of what percent or what share of global market value was set by Tether, and what would be the resolution. I don't know, and I don't think really anybody knows. Yeah. And for some people, right? For some people, they say Bitcoin is uninvestable until Tether is out of the ecosystem.
Yeah, that's why. That's exactly what I was thinking.
I think that's that's an interesting take. The problem with that is that they might be waiting for a very, 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 very long time, because there's a whole lot of vested interest in kind of keeping this game going, and I think the longer that Tether is around, and they have now a very liquid portfolio of short-term treasuries, it's going to be really hard to bank run or to see that run resolve. So I'm not making any like bold predictions or not. Like I'm not saying that like there is absolutely a non-0% chance that there's bad outcomes with Tether and with their holdings and maybe potentially with the price of Bitcoin. But I think it's not it's not certain either way. I don't think it would be really I would really be in the right to come out here and make one bold claim either way.
Okay, all right. Well, I think that there is definitely risk, as you said, certainly risk there. I think the risk to actually Bitcoin's price is maybe a little bit overblown. To your point, a lot of people say it's uninvestable until we figure this out. It's like, why? Like, I don't see that, like, they're not going to sell it. Now, if they had said, hey, well, half of our collateral is in Bitcoin, well, shoot, then they'd be forced to dump the collateral. That's not the case. So, like, I just don't see why anybody would make that assumption. But to your point, a lot of people have. I think a lot of people that are outside that are probably wouldn't buy Bitcoin anyway, and they don't really understand how that works. One last potential big blow up, kind of just going back to, are there any more sellers? Are there any more forced liquidations? Something you've been talking about quite a bit is Silvergate Bank. Now, there's a lot of problems with Silvergate Bank, including potential legal problems, because apparently they were handling wires for Alameda and FTX, and they weren't doing proper KYC and putting money into the wrong accounts. I mean, who knows what will come with that. Lots of other risks with Silvergate. What are you seeing with risks with Silvergate, and I guess frame that up?
Yeah, so, I mean, I was aware of Silvergate and their role in the kind of the Bitcoin crypto ecosystem dating back to 2021. It was kind of big news because they were, a Fed member bank that was giving collateralized loans to MicroStrategy and Marathon, some big public names, right? It was the first Fed member bank to extend USD credit against Bitcoin collateral. Like, that's obviously a big story. And aside from that, like, they had a really dominant role in the crypto ecosystem, the Bitcoin ecosystem, due to the SEN network, S-E-N network, Silvergate Exchange Network. That's what SEN stands for. And really, that was just crypto firms, Bitcoin firms could deposit to Silvergate and then transact with each other 24/7, kind of on dollar rails. So similar to kind of a dollar stablecoin, but it wasn't a public ledger. And unlike a stablecoin like Tether or even a USDC, this was in an account at a Fed member bank. So they their deposits grew massively. I believe it was over tens of billions of dollars. And some of these exchanges that had trouble getting official dollar rails like an FTX per se, kind of leveraged Silvergate's SEN network to do so. And so post FTX collapse, there's been a ton of regulatory pressure, and that's when I really started to pay attention to them. Was okay, what's their dollar rails, because this is a massive fraud. FTX Alameda, what they were doing, the commingling of funds, this was a massive fraud, and it took about 3 to 4 minutes for me to just land on Silvergate's website. And funny enough, FTX collapsed on the 8th, right? I went on Silvergate's website, I believe on the 9th, and I posted this. And on the main page, they didn't even delete it yet, was a quote from SBF saying, like, Silvergate has really revolutionized the role of for blockchain companies. It's made this all so much easier. And I look, and Silvergate connects all of these counterparties through the SEN network. So, I mean, since then, the shares of Silvergate are down 75, 80%. They're down 90 something percent from the all-time highs. And I don't really know how it resolves. I just know that there's been a big run on their deposits, right? So they've had to sell a lot of their bond and securities portfolios to stem that run. They now have more excess cash than they do crypto deposits. So I don't think like an insolvency is around the corner per se. But what I do think is going to really intensify is the regulatory pressure. Right, not just for Silvergate, but also like say a signature bank. There's like really the only two crypto banks for U.S. companies that worked with U.S. crypto firms at scale. And due to just like the Alameda FTX money laundering situation, I think that the AML, anti-money laundering, and the bank regulators are really going to clamp down hard here. So I mean, I don't have a bullish or bearish view on Silvergate stock here. Disclosure, like I was short the stock, I'm no longer. But yeah, I think that's just an interesting story from a crypto native liquidity standpoint, is that there's only so many dollar rails here, on ramps, off ramps, and Silvergate, serves Circle, Coinbase, Gemini, like all of these big names use Silvergate at least partially for their dollar on and off ramps. So depending on what happens there, that could have an impact on the crypto native liquidity. So don't have a strong stance of how it resolves, but I think it's something worth watching.
Yeah. If we put that aside, I mean, what happens with Silvergate, and do they stay in business? Do they not? Their stock go up, down, whatever. Put that aside. But if they were to go down, what does that have effect on Bitcoin, if any?
Yeah. So I mean, there's one thing I think of is that MicroStrategy has a $200 million Bitcoin collateralized line of credit with Silvergate. Silvergate doesn't hold the collateral, so it's not like it's going to be a force sell. But it would potentially, there would be maybe a call of margin, or a call to pay off that loan. I'm unsure. I can't speak with certainty of how the loan documents work there, but that's a potential. I know that USDC, who has like 8 or 9 banks, but banking partners, but one of their relationships is with Silvergate, so there's potentially some risk there. I mean, again, I'm not saying that USDC is unsafe, but I just think that it would just kind of be another problem for a lot of these crypto companies, and specifically the unregulated ones, right? So we've seen that Silvergate and say even Signature, right, have serviced Binance on and off ramps for dollars through like shell corps, right? So they have a different name than Binance because they're not a U.S. institution, but they've accessed dollar rails. Same with like Huobi and other names. So who knows how many crypto relationships they have disclosed or not underneath the surface. And so if they blew up, like I don't know if it would have an immediate impact on the Bitcoin market, right? Bitcoin's a $300-400 billion asset. Silvergate's market cap is like less than $1 billion. So it's not like a massive thing at this stage in the game, but just certainly something just maybe keep in the back of the mind.
Yeah, good. Well, man, we walked through a whole bunch of stuff. I feel like we've done a pretty good job there. I want to just kind of circle back to where we started in the beginning, talking about the big Fed kind of macro outlook. You threw out something I didn't ask you out, but you said you mentioned the S&P going down to 3,000. We're at about 4,000 now, going down to about 3,000. Is that your charted kind of case of where you think it could go to this year?
Yeah, I mean, I think that's certainly in the realm of possibility, probably more so than market participants expect. I think
would that be your base case, like above 50% chance that happens?
It's a tough question, Mark. You're putting me on the spot. Yeah, I think we see it at 3,200 at least, and maybe not even in 2023. One of the things that I've been pleasantly surprised with is how strong and resilient the economy has been to the rate hikes. But in terms of, if you just think about the pricing of stocks, right? Whether you look at, market value to GDP, historically over bloated, overvalued in 2021 into 2022. That's reset a bit, but it's still historically overvalued in historical measures. And so something like that, I think really the only thing that's been discounted in equities has been the discount rate, right? Earnings haven't really been revised lower at all. If we see a recession, that will happen, and also credit standards, right? So if you just think about one of the biggest drivers of the bull market for the last 10, 12 years, it's been debt finance corporate buybacks, right? So if that's done, if the boomers are retiring and forced to liquidate, right, like 2022 was the line in the sand for the boomers actually crossing the threshold of average retirement age, the biggest generation in history. So are those boomers now net buyers or sellers of equities as they're retiring, right? So these are all things that I think are more structural. I think making a call with a specific number line in the sand is not something that's, it's tough to do, right? But I'm not uber bullish in 2023 with the S&P at 4,000. I'll say that.
Yeah, you threw out the number 3,000. I was just circling back to that. That just for frame of reference, that's about where we were in 2019. So we'd kind of go back to like a 2019 level. We kind of sat there for most of the year. In reference to what you were just saying about the baby boomer generation, the largest segment of the population, they're all retiring. Will they be net buyers or net sellers? Well, the answer is actually they'll be net sellers, because if you go back to a law that was passed in the 1970s, which is called ERISA, which is basically allowed people to put money into their pensions, but they have to start selling them when they retire, so that the government can now recoup that tax dollars. So they were able to put money in tax-free. The government knew that they would have to sell, and then they'd get the tax dollars back. So they're forced to sell. And they're certainly not buyers, right? They're going to be moving out of the market. They're forced to sell. They're not going to be buyers. So I think there's going to be massive downward pressure from that law. Unintended consequence of government intervention in the 70s is going to come home to roost now. And then with interest rates so high, these corporations are going to have a very hard time rolling over debt and getting financing at all. And over the last couple of years, the majority of these stock buybacks were being done with cheap access to credit. And so you take away the cheap access to credit, then the buybacks go away. And then you have the forced selling from the baby boomers. There's a lot of downward pressure on stocks. I don't see where the upward pressure is going to come from. And so I think that's going to be a big trend to follow for sure.
Yep, I think you nailed it on the head. The biggest trends for me in terms of equity markets in 2023, 2022 was the year of duration, right? Yields repriced higher, the valuations repriced lower. I think 2023, the story is earnings. We'll see how that plays out, and maybe that goes into 2024. And also, we have credit standards, right? So credit spreads, credit risk. These are the things that really equity markets today have not experienced in the last 2 decades. And so, if it comes to roost, then, the pressure certainly remains skewed to the downside.
Yeah. The one benefit that they might have is that inflation is going to push up their earnings, and it's going to look like maybe that might help them a little bit. We'll see. But anyway, man, Dylan, we have covered so much. I think we've hit it all, starting with the big picture and kind of diving all the way down into kind of Bitcoin risk assets and back out to Dylan's prediction of where the market's going. I'm just kidding. We won't put that out. But anyway, man, I appreciate it so much. You can check him out, Dylan LeClair _ on Twitter, and you certainly should give him a follow. Anything else we missed?
I think we covered it all, Mark. This was a good rip.
Man.
A lot of action-packed hour.
Yeah. Well, thanks so much for joining me, man. Always a pleasure. Look forward to seeing you sometime soon. And with that, we'll go ahead and sign it off.
Cheers.
All right, that's a wrap. Hopefully you enjoyed this conversation with Dylan. I know he's young, but don't let the age fool you. Comes down to two things. One, how much time you put into your craft, how much time, and he spends a lot of time. And two, it depends on how well you understand it. And this kid is wise beyond his years. Now, like I said, the world's changing. The strategies that we need for this new world are changing. And I believe there's a big opportunity, a much needed opportunity in building out a brand new parallel economy, parallel markets. It's happening. Whether you want to or not, there's a massive opportunity to build wealth and protect our wealth in that parallel economy and affect massive change. I'm holding an event. I'm going to have really some expert speakers coming on, Robert Kiyosaki, other experts to talk about this new parallel economy. You can check it out. There's a link down below, or go to go.onemarkmoss.com/parallel, go.onemarkmoss.com/parallel, or check out the link down below, and I'll see you there. Otherwise, as always, leave me a comment. Let me know what you think about this interview. What do you think the forecast for 2023 is? Of course, as always, give me a thumbs up on this video if you liked it. If you don't, give me a thumbs down. That's okay. But at least leave a comment and tell me why. Oh, hit that subscribe button while you're at it. And that's what I got. To your success. I'm out.